Thank you, everyone. So we've got a lot to cover in a relatively short time. But before we get started, I would love to do a round of introductions. I think Frank has done a very thorough introduction already. So maybe we can start with Sue and go down the line. Share a little bit about yourself and your role in the mining business.
Yeah, so my name is Sue. I'm head of IR and GR at Hut 8, and we're one of the oldest Bitcoin
Sue, you have to
miners
talk closer.
in the industry. We just completed one of the largest mergers in the industry in December. We merged with a U.S. private Bitcoin mining company called U.S. Bitcoin Corp. And yeah, it's been a pretty wild ride and excited to get into it today.
I'm Sullivan, the CEO of Core Scientific. We're one of the largest Bitcoin miners in North America. We've led a number of Bitcoins mined amongst publicly traded mining companies since 2021. And we're continuing to expand our footprint in Texas. We currently operate 7 facilities across 5 states, representing about 750 megawatts.
Hi, my name is Kerri Langlais. I'm the Chief Strategy Officer of TeraWulf. We are a zero-carbon Bitcoin miner. We've got 2 facilities, upstate New York and also in central Pennsylvania, where we're also directly connected to a nuclear power station. And thank you for having us here.
Great. Well, thank you, everyone, for joining in this session. So we're going to be talking about strategies post-halving. And I think, we've just gotten over one halving, but actually we have another one coming, right? We always have to think not only about how we're dealing with the last halving, but how we're going to deal with the next one. And I think that what has really been an emerging trend or a continuous trend, and is going to be ever more important going into this cycle, is really how miners work with grids and work with power companies. And the role that they play. So, Sue, I'd love to start with your input on how the mining industry is evolving as a service provider to grids rather than just a large off-taker.
Yeah, so I think one of the really interesting things that we're seeing right now is the advantageous position that miners are in. We've effectively been building up the power that no one wanted since 2017, 2018. And now we're in a situation where, because of the demand for AI, reshoring, EVs, the battery technology revolution that's happening in North America, there is a tremendous amount of demand, but grids are not scaling. Another thing that we're seeing is how renewable energy. So there's something like 26 gigawatts of renewable power that's coming online in the next 2 to 3 years in the US alone. And I think the role that miners play, and one of the problems with renewable grids, is that renewable grids are intermittent. And so grids at all times need to be balanced. If you have intermittency happening at a grid, that is not good. That's when you have brownouts, that's when you have blackouts, and curtailment needs to happen. And so the role that miners play with renewable grids is that they actually act as an off-taker of demand and a load balancer. And so again, I think this is a really interesting confluence of sort of events, and there's a real opportunity for miners to continue to grow their partnership with renewable power players. Hut 8, for example, we already have 2 renewable power players that we have partnered with, and we help them with load balancing. And again, I think just seeing how this trend continues to play out as more renewables come online, as power continues to be constrained, and data center operators, renewable power players are looking for more alternative energy and alternative energy systems. I think, again, the role of miners is only going to get greater, and it's pretty exciting.
Adam, in previous cycles, we saw kind of a reach for big mega sites, trying to achieve some scale economies to be more efficient. Do you think that is going to be the dynamic going forward, or how do you see miners evolving with large mega sites or smaller sites, and what are the reasons driving that?
Yeah, I think where we're at right now is interesting. So you mentioned we have to think about the next halving, the halving after that. I mean, it's absolutely true. I mean, infrastructure is at minimum a 3 to 5 year game. I think the proof is in, a lot of the plans that were set out in 2021 for miners. They're just starting to bring them online today. I think, at least in the United States, we've kind of found most of the large power sites. I think Riot's announcement around their gigawatt site is probably the last large site that is going to be announced, really probably over 250 megawatts in the United States. The demand across the board from AI companies alone is eating up all available power that's out there. And so that's also pushing up power costs in all of the regulated utilities that at least we operate in. And I think that's something that we're going to continue to see going forward. I think that's going to push a lot of Bitcoin miners into a lot of smaller locations where there are bespoke power strategies that they can find power arbs that allow them to actually operate with 60% uptime, 70% uptime, and provide them actually low power costs. Because I think by the time we get to 2028, unless you're willing to refresh your machines every 2 years, you essentially have to have a full life cycle of different style power contracts that allow you to operate some sites at high uptime, might be a little bit higher power cost, but that's where your new machines are going to go. And then every year you're going to be moving them down the stack to lower power cost, higher intermittency sites. And so if you have that full spectrum of availability, that's really what you're going to need in 2028 so that you're not spending capital every 2 years on refreshes.
Last year, on the same stage, we had a panel discussion around M&A and consolidation in the mining sector. And, with the exception of, a notable transaction with Sue's firm, there actually is not a huge amount of M&A that's been happening in the sector. There are, trades here and there, but not as much as some might expect, given the kind of potential tendency towards consolidation. So, Kerri, would love to hear your thoughts around M&A, consolidation in the sector, whether you see that potentially being something that we're going to see in this cycle more frequently, or if not.
Well, listen, I think, there's 24 public mining companies, and I think probably each and every one of them have probably had a discussion at one point or another about whether it makes sense to combine. There's certainly a very strong argument for it if you think about the public company costs alone to run a company, and then the G&A. You know, if you think about Bitcoin mining, there's really three cost buckets. It's the power costs, your operating costs, and your SG&A. And in those buckets, if you're able to extract value, I mean, you can have very significant synergies and really elevate your ability to produce, the lowest cost Bitcoin. So I think, there have been challenges. There's been social issues. The SEC is not very helpful, and Sue has lived through that, and things take a lot longer than they should. And so I think, as we look forward to the next 12 months, I think you'll see a lot of smaller, probably, M&A opportunities where sites may change hands, or some of the smaller Bitcoin mining companies that haven't achieved scale might be purchased up. But I think, there's certainly the argument to be made for some of these companies to combine, and certainly at a site level.
Frank, so going beyond consolidation, one potential strategy, firms becoming more efficient, and seeing combination as possible in order to achieve that, maximize shareholder value. Another strategy is diversification, diversifying into other revenue streams that are synergistic with mining. So, Frank, you talked about that in your presentation, and some of the things that you've been doing in AI, for example. How do you see the diversification into AI verticals as part of the strategy of miners, and what are some of the challenges in doing so?
I think wherever you go in any jurisdiction, there's complications, and there's always these nuances. But one of the parts in our strategy was to be globally diversified, and so that was going into Sweden, going to Iceland, going to Canada. I think some of the other mining companies have diversified outside of the U.S., and I think that's going to be wise, because the concern was next year, Biden wins the election, a 30% tax is threatened on Bitcoin miners. So will that take place? I think that we're just going to recognize as being early in this great adoption of Bitcoin as a digital asset, and the significance of the global network. There's something like plus 18,000 active nodes validating the network around the world, and there's 195 countries and 150 real central bankers. So the network is so significant, and I think it's going to continue to evolve. So as a miner is to make sure that you're diversified. So now coming back to these mergers, it's culture. A lot of times the cultures actually don't work, and where it's now become much more professional, where the leadership is actually maintaining the entrepreneurial spirit, I think is going to be key to see the 24 miners actually coming together.
So Sue, we were talking a little bit about M&A as a potential post-halving strategy in this cycle, and Kerri referred to acquisitions of sites. We had a conversation before about this site level versus company level M&A. So when you look at your corporate development strategy and the corporate development strategies of your peers, where do you see as the differences between site level and company level M&A, and what are kind of some of the benefits of integration if they're only at site level?
Yeah, so I think, HUD-8, we did a company level merger, and one of the things that we really liked about the company that we merged with US Bitcoin Corp is that they had this business called managed services. And so that business is effectively like an enterprise end-to-end energy infrastructure partnership model. So the business already actually exists in the oil and gas space. So Halliburton is a big company that is tasked with helping oil and gas build out infrastructure. And so US Bitcoin Corp had effectively copied that exact same model, but for the energy infrastructure space with respect to Bitcoin mining. So on the company level, we really liked that's what came with this deal. I think moving forward, at least from HUD-8's perspective, as we look at M&A, it's certainly, I think, going to be more site specific, because effectively the bet that we're making is that the value of stranded electrons will only increase. And so our goal is to capture as many cheap megawatts as possible, continue to hone our expertise in building up cheap megawatts at a discount to industry averages. We build at about a 30% discount. Because again, we think that the value of stranded electrons will only increase. And right now, the best ROI to capture that value is Bitcoin mining. But as we can see, as AI has come down the pipeline, and particularly in terms of AI training models, there's certainly value for those electrons there. But as we look 2 or 3 years out, if you look at thermal energy, green carbon capture, that's effectively the bet we're making, and why we're focused more on site level, capturing as many cheap megawatts as possible and continuing to flip them and scale this business into the highest ROI and use case of that stranded electron.
Going on the theme of consolidation versus diversification, Adam, Core Scientific has made some notable achievements into the AI space. Recently publicly announced a deal with CoreWeave. So maybe walk us through your strategy and your thinking around that, and how, when you look at your business as a Bitcoin miner, as a large capacity off-taker, a load balancer to grids, how you think the other revenue stream, the AI revenue stream, plays a part in your portfolio, and how it synergizes with the others.
Yeah, so our strategy is really Bitcoin's the entry point. Bitcoin is synonymous with abundant energy. And so our goal has always been to find high power sites that we can deploy Bitcoin mining at, and then ROI all of our energy infrastructure. And then as we start to have a more mature site, have a better relationship with the power provider, we can then look at all the different programs that are available and then figure out how to maximize the value of that asset. That's something that we've gone through over the course of the past year. In fact, we ran GPUs for CoreWeave since 2019. So it's a longstanding partnership between the two companies. But for us, we have a portfolio of 1.2 gigs of power, and what we're looking at is how do we maximize the value of those assets? And so, we've identified a number of our different sites. We were buying mega sites back, 2018, 2019, really before the bull run in HPC and data centers, and a lot in Bitcoin mining, at least in North America. And so we had the opportunity to grab a lot of sites that have really attractive features. And so that's something that, right now, there's a huge demand, not only in Bitcoin mining, but also in HPC. And so, figuring out the best way to maximize the value of those assets. And, there's a significant demand for people looking to deploy more quickly. And so large tech companies willing to pay for CapEx, those are really intriguing features for a company like ours, where as I believe Frank mentioned earlier, it's almost $10 million a megawatt in certain situations to build out this infrastructure. Given our existing footprint, it's a little bit less than that. But having large tech companies as partners is a really great place to be, especially as, you're looking at a large portfolio of megawatts, and it provides a significant runway and opportunity for Core Scientific going forward.
Just to compliment Adam, for simplicity, you can get your pens and piece of paper to write this down. To get $100 million of revenue in Bitcoin mining, you need 100 megawatts of electricity. To get $100 million of revenue in high-performance computing, you need 10 megawatts of electricity. So big difference. Then to build out for that 100 megawatts, you have to think of, again, you have to spend $1 million per megawatt, approximately. Some get deals better, cheaper, et cetera, but let's say $1 million. But for HPC, it's $10 million. So there's a bigger front-end load, and the complexity of hooking up the right cables to the NVIDIA chips with the server is much more challenging than just saying, I bought a bunch of H100, so we're in business. As you know, it's much more complex. So I think partnering with CoreWeave and that whole strategy, they have that intellectual capital, and they have the access, like HIVE is a platinum relationship with NVIDIA, and so therefore we have access to NVIDIA chips, and then that's very important in how you get those chips on a timely basis. But I really think this idea of understanding Bitcoin mining versus
So I would also actually just like to encourage anyone in the audience, put up your hand at any time, and we'll bring a mic over to ask questions. Otherwise, I'm going to keep firing away. So we talked about investment strategies, consolidation, M&A, diversification, looking at alternative revenue streams. Let's talk about the other side of the spectrum, some of the other key decisions that you have to make as miners and how you finance your business. How have financing, one of the things that we've seen over the past 18, 24 months is certainly availability of credit has been relatively constrained for the mining industry. A lot of, erstwhile creditors have said we really want to see how things look after the halving. ATM windows have become had periods of being more open than in the 18 months preceding that. We've seen capital markets become more open. So, Kerri, would love to hear how you are thinking about the financing conditions after the halving, and how financing conditions are continuing to evolve, and how strategically you think about financing your business, because this has been one of the key determinants of success and failure of mining businesses, not just how they deploy their assets, but how they finance their company.
Sure. Listen, I think Bitcoin mining is still a relatively nascent industry, right? And so until you have, hedging programs that are efficient, I think you're going to lack the ability to have debt financing that is going to be, additive to your capital structure. So I think we're starting to see some hedging products come out. Luxor came out with, hash price hedge, but I think until that becomes more mature on the hedging side and available, and once that does open up, you'll see a lot more debt financing. Just like in the commodity business, we at TeraWulf view Bitcoin mining very much as a commodity. And so like oil and gas and like the hedging that's available in that industry, once it's available, you'll see the financing start to follow. On the equity side of the business, our management team owns over 40% of the company. And so when we think about financing with equity and funding our growth with equity, it has to be accretive. And when I say accretive, it has to be accretive from a profitability standpoint. I think one of the dislocations you see in the market now is that a lot of the public miners are being valued based on their exahash or revenue capability, and not like a true commodity based on their profitability, which is EBITDA. So when we think about issuing equity to fund our growth, we look at whether it's going to provide the return on our profitability that's accretive to the company. And so, all of us in this space are building our businesses. We're building our infrastructure at TeraWulf, so we prioritize every dollar that we spend into our infrastructure the rise of AI and the demand on these locations that are scalable and have access to low-cost power, green power that's sustainable is very important, obviously, for these big data center entities. So we are focused in prioritizing that build-out, but we will do it very carefully and patiently to ensure that it's accretive because, like our shareholders, we only win if they win.
That word's not in this industry, accretive. But to complement what you're saying, in 2004, and I'm known for the world of gold, I wrote books on gold and have a following, and it made it easy for me to go into the Bitcoin metaverse from the gold space. And in 2004 came out the GLD. And the GLD was extremely disruptive to the gold mining industry. Prior to that, gold mining companies were just making these incredible acquisitions for top line growth and EBITDA, but on a per share basis, it was devaluation. And what you saw was this huge bifurcation between companies that really understood that the deal was accretive versus just growing for the sake of growing, and their stocks kept falling and falling. So this century, gold has outperformed. When you take a look at the S&P 500 for comp, it's outperformed it by 50%. But gold stocks, minus 30%. And it's been a small group of gold companies that were really respective of the valuation of, is this transaction accretive? So I think that now that we've had the halving, we now have a Bitcoin ETFs that are growing in Hong Kong this week, et cetera, that there will be a separation in the mining industry for those that just use the ATM for the sake of growth, at any sake, then that will go through a transition because the Citadel Capitals of the world, they have a quant approach. They're going to look at enterprise values. They're going to look at EBITDA ratios, et cetera, and that will be the transition.
I think that's right. It's like the telecom business in the 90s, right? Or the power business in the early 2000s where it was about empire building. And I think what you'll see now post-halving is there's going to be quarters where some of the largest public companies are going to post free cash flow negative quarters. And I think that will be sort of alarming and the capital markets will do its work. But I think up until now, everything has been very much equity funded and without really a blink of the eye. But I think that will soon change.
Yeah, I actually think that's going to change M&A. Initially, I was so bullish on only facility level acquisitions, and I think that's going to play out for another month or two, but there's a lot of miners out there that are only marginally profitable right now. And you mentioned negative free cash flow quarters. You post two in those in a row, you're going to have a really hard time surviving. And I think that's actually going to start to drive more public-to-public M&A when boards start to realize, well, we're not going to get out of this by increasing our multiple. Like, it is not that easy just to go out and increase your multiple. And so there's going to be a lot of the larger miners who are trading at premium multiples that are going to look around the space and go, well, yeah, I can pick them up for 150% premium that the board can't reject, and it's still extremely accretive to us. And that's what you're going to start seeing, I think, probably starting in Q3. But the problem with those deals, obviously, is it takes 9 months is a fast deal in the public markets, right? And so it's going to take time, but I think there's going to be a lot of assets. There's going to be a lot of teams that provide a lot of value to some of these companies that desperately need talent, desperately need more sites. And I think that's going to actually end up being a driver to actually the move back to public mergers.
And for those of you who were on M&A discussion last year, this was a key conclusion and a message that I was personally hoping to drive forward is that in M&A, we really need to look at accretion models. If we're just looking at things at M&A based on pure valuation metrics rather than relative accretion, that there was going to be a lack of deal making that could otherwise be helpful for both the buyer and the seller and ultimately their combined shareholder bases. But looks like we have a question from the audience.
Paul Prager, also with TeraWulf. I think what Adam said is dead on. I mean, a lot of companies, why be acquired if it's, you end up being acquired by a company that can't make money mining. And so that really drives the issue is why aren't you all pushing for the notion of everybody being transparent with the unit economics? I mean, if everybody is transparent with the unit economics, you could figure out, okay, that merger makes sense. Maybe it doesn't. But that should be the driver because that will ultimately lead to legitimate M&A or no M&A.
You're absolutely right, Paul. If you look at every different firms and every Twitter personalities charts of what their total cost to mine is, every single chart is different. Every single person has come up with a different number. It is extremely hard for even people in the industry to know if someone's telling the truth or not. And so for us, I was a former banker. It's like getting involved in certain companies, and when you're looking at targets for companies, you're going, oh, well, the actual unit economics here are completely different than what they're telling the public and what they put in their presentation. And that was always really challenging, and that was the biggest hindrance, I think, for public-to-public M&A, is that a lot of people in the industry, especially on the smaller side, are not as truthful as you'd like them to be. And so that's really been a huge hindrance to public M&A.
And that happened in the gold industry.
Leaves a cloud over the
That
sector.
was the gold stock industry was exactly that until the World Gold Council came up with a standard of all-in sustainable costs, and everyone had to comply with that. And then you saw more M&A work, so that it was easier than for deals to happen.
Just a final question for the panel. We covered consolidation versus diversification. We covered financing. I'd just like to ask one final question, and either Frank or Adam take this one, is as you look into your diversification strategies into HPC, how are financing conditions driving those decisions? As you noted, Frank, in your presentation, there's a huge difference between how data center businesses are valued and financed versus how miners are valued and financed. And one of the challenges we've seen is that in some cases, from a financing perspective, 1 + 1 equals less than 2 when you combine these businesses, considering that the financing parties that may like or value one side of the business very well don't value the other as generously. So if either of you could touch upon that.
I think we all started with there was no path in the capital markets for Bitcoin people outside, and there was this whole audience of baby boomers that want to buy, but they were afraid, and the miners became their proxy. So Bitcoin miners was a proxy, and that proxy was substantially disrupted this past quarter with the launch of Bitcoin ETFs. And I've seen this in other industries, in particular the gold. So I think that we're going to go through as an industry group. We're not just the only path for Bitcoin mining play. And hopefully you'll see a difference between who hodl their Bitcoin and who do not. The gold stocks that used to hodl their gold traded at a much higher price to book, and they had a much higher retail following. When they sold their gold, didn't matter if cycles are up or down, they went through a re-rating. So we'll see. We're a young industry. The nice part I share with you is that there's so many professionals. Like, this is a real professional group compared to 8 years ago, launching the creation of HIVE. So, and we've got Fred over here, another fellow YPOer. The core has 3. We have 4. The professionalism in the industry is gone through the roof. Ned Goodman was also instrumental as a gold miner for the intellectual capital, and you see that with Riot. We were all laughing that we were all baptized by Ned Goodman about this is how you run a mining industry, and this is a business. So it's a wonderful new industry.
Well, we are out of time, but thank you to my fellow panelists for coming on. I'd just like to thank everyone for the audience, and sorry we didn't get to come.